Okay, good morning. It is Tuesday, June the 20th, and welcome to the Gilberto Levy High Yield Real Estate Debt Conference. I'm John Levy, and very pleased to have you. Welcome back from your holiday if you took it. Do you want to move the? There we go. So sorry for the technical difficulty, comes with the territory, I think. So again, welcome to the GL2, our high yield investor conference. I can't believe it, but this is the 8th time we've done this. And Michael, I can remember when we first started that we were in a very modest sized conference room with a table. And we all gathered around, and there was plenty of room for more participants. To say the least, it wasn't even remotely crowded. But today, there'd be really no conference room that worked. We have a huge crowd, and we'd have to find a nice size auditorium. So if you are a founder, and this is your 8th time, welcome back. And if you're new, we're delighted to have you. Just to give you a little thoughts on what we're going to do this morning, with housekeeping, question and answers are welcome. We'll answer them as quickly as we can. So if you have a question, go down the bottom, submit it, and we'll try to get to your question. If we don't, we will call or send you a note this week so that you'll have an answer. So nobody will be left out, but we may not be able to get all the questions in during the allotted time. We have a lot of new participants, quite a lot of new participants. For the first time, we have a pretty good sized European contingent. And I think that's because we are involved in what's called the GL3, which is high yield for Europe. So if you're tuning in and interested in the GL3, welcome. And if you're interested in the GL2, which is American assets only, you're always welcome. All of you are on mute, as you might imagine. And so if you do want to submit a question, please do. I might note that all of our slides are copyright. So if you'd like to use them, please call us or email us, and we'll try to make them available to you. The agenda today is similar to what we've done in the past. We'll start with an index overview. For those of you who have been here before, you'll say it looks familiar. It does. But there are a lot of you that haven't been here, so bear with us. Then we'll talk about performance. Michael has a really fascinating section on winners and losers, and then we'll do concluding remarks and our view of the road ahead. No, there we go. The GL2 is the index for high yield commercial real estate debt, or private credits, or private capital, as you might call it. We measure both total return and its components. And for those of you that are wondering, our index is consistent with other fixed income indexes, including the GL1, stock indexes like the S&P 500, and real estate equity indexes such as the NPI and IPD/MSCI. Interestingly, the GL1, for those of you that aren't familiar, is our original fixed rate first mortgage index that measures the performance of insurance companies and pension funds. We now have 50 years of data. I can't believe it. And I think the total numbers in the index are 1.6 trillion with a T. We've designed the index for portfolio managers and investors for capital allocators, and for consultants. And there are quite a few consultants this year. So if you're new to that group, welcome again. Interestingly, just to give you a little size of what we're dealing with now, we now have history on over 1,000 positions. Just amazing. And we now have 13 years of data. The data you'll see today, for the most part, is complete through the first quarter of 2023. Some of you may remember last year, we didn't quite have all of the first quarter. We were preliminary, but now we have first quarter data. So when I think back on the 13 years, I think, wow, this is amazing. I can remember when we were started, and I thought we'd be lucky to get to 13 months. We have two people joining us that you guys may not know, or you may know of. One is Julia Grant. She works here and has been trying to keep me on the straight and narrow for over 25 years. She can't believe it, and neither can I. Welcome, Julia. And we also have Alex Michaelis, that I think a number of you know. Alex joined the GL series last year, and many of you may know him from the State of Wisconsin Pension Fund or from the New York Common Fund. So we're going to turn to the GL2's, the Total Return Index, and here to handle that is Alex. Welcome, Alex.
Thanks, John. So the GL2 is produced quarterly with monthly returns. Those monthly returns are calculated utilizing daily weighted cash flows and follow the GIPS methodology. The same approach is used whether it's a single investment, calculating a portfolio for a portfolio manager, or for the entire index. Those monthly returns are then chain linked to produce a time-weighted return, whether it's a quarter, year, 10 years since inception. And the components of that total return, of course, include the income return as well as the capital value return. Within that capital value return, that includes the cash flows, whether it's a contribution or a distribution, as well as changes in any investment value. Changes in investment values, important to note, are reported directly to us by the participants and include a mix of both internal and external valuations from those firms. Next slide. So moving on to the income component of the returns, this includes cash interest received, as well as any accrued or capitalized interest, other income, which mainly comprises of fees, origination fees primarily, which gets us to our gross income. To calculate our net income, we then back out any expenses allocated to the loan, as well as any interest expense incurred for loans that have been subsequently levered. Think a leveraged whole loan, which gets us to our net income return, which is then reflected in our net total return. And as part of our quarterly production and reporting back to the participants, they receive full detail of all of these components as part of their return series. And with that, I'll pass it back to John to.
Yeah, I think, thank you, Alex. One of the things on the returns, as I mentioned to you earlier, we will have the first quarter reports to all the participants out later today. So if you're a participant and you want all the details, stay tuned. You'll have it before you leave the office. Okay. I think it's pretty clear from this that the GL2 has really been growing. We're now the better part of, call it, $50 billion, and we're getting in data on a regular basis. Interesting, the value of the real estate or the collateral underlying that is about 300 billion. And as you can see, not that long ago, we were 20% of that total. a little over 11 billion. Now we're the better part of 50 billion. But as we get more backfilling and more data, obviously that number goes up. And from what we've seen recently, we expect to report a substantially larger number to you next year. All right. This is a table that really shows what's going on with the assets. And I don't think it comes as much of a surprise to you. So start on the left side. And what you'll see is the bar for 2010, the gray, and that's consistent, the color's consistent, is stabilized. So in 2010, virtually all of what we were doing was stabilized. But what you can see is the amount of stabilized has gone down almost in a straight line. So that stabilized, which was 80% of the deals in 2010, is now less than 20%. But what's grown dramatically, and again, go back to 2010, see the little blue sliver? That's bridge and transitional. And then if you go and follow that across, that and the yellow, and yellow is value add, that's the bulk of where we are in the GL2. Okay, again, very similar, no surprise here. So when we started in 2010, a good percentage of the deals were fixed rate, and that's the blue bar. Now you can see that fixed is just over 10%. So virtually everything has gone floating, and it's very consistent. And there's some hybrids, which not a huge component, but basically most of the deals in the GL2 are now floating rate. And I think that meets with what you know from the market, because most of the deals we're looking at are a 2-year deal or maybe a 3-year deal, or with 1, 2, or 3-year extensions, and they're all floating. Interestingly, again, start on the left side. The blue bar is office. Now, I know we probably not supposed to use that word today, but it was over 60%, and now it's 20%, and as you might imagine, declining. The orange lines are for multifamily, again, up dramatically. Certainly no surprise there. And industrial is up. So between multifamily and industrial, we're now over 50%. And if you went back to some of the earlier years, you could see that office was still over 50% for a long time. The GL is very different. The GL2, excuse me, is very different than GL1. So I think I mentioned to you earlier, the GL1 is all fixed rate first mortgages. So there's no subordinate debt, there's no nothing. It's all first rate, first mortgages, fixed rate. But the GL2 has got a lot of room. It's fixed, it's floating, it's various loan types. And what we've shown you in this tranche, or in this picture, is exactly that. So look at the upper 4 lines, which are shaded blue. Those are subordinate debt. That's exactly the subordinate debt component. The green line is kind of interesting because that's senior whole loans. And the senior whole loans, have gotten a lot bigger. It wasn't that long ago that 15% number was well under 10. A little bit later, Michael will step up and start to talk more about leveraged loans. I think this is the chart that you guys asked the most about. So I called it a Christmas tree chart, but there's not enough red and green. So it's just a multicolored chart. And this gives you an idea of where the transactions are being executed. So stabilized transactions are in blue. The orange are for bridge and transitional, and the gray are for value added. Now, what's particularly interesting here is we've got a wide variety of transactions from less than 40% to 80%. And what that means is that if you would like an index that is custom for you, because it's not your index or your needs don't meet the plain GL2, we can give it to you. If you want attachment points that are slightly higher, slightly lower, if you only want to include certain metropolitan areas, if you only want to assume certain property types or sizes, we can give you a custom mark, a custom benchmark, so that you can compare what you're doing to the index without having to look to the very generic index. Now, one of the things I think it comes up as a surprise, certainly to me, was that if you look at the attachment points, the lower and the upper, I don't know what I thought was going to happen, but I thought the upper attachment point on average would be probably in the early 80s, 81, 82. It's never been there. The leverage is a lot lower than you might have suspected. So the upper attachment point this year is 68%. The lower attachment point is 51%. And again, keep in mind, this is a high yield index. So below the attachment, the lower attachment point is something that is senior, a first mortgage in most cases. Interestingly, that upper attachment point has trended down a tad. So last year it was 71%. The year before it was 70%. This year it's 68%. I'd be surprised if next year when we came together, it wasn't down even further. I rather like this table because a lot of you have called to ask about, we know how the GL2 does, but how does it do compared to other assets? So here's a table that talks about this. We've compared the GL2, which is the left-hand column. The GL1, we've told you, is our first mortgage fixed rate index. The next column is for investment grade CMBS. And then the next column is for corporate high yields, intermediate term high yields. Probably the most interesting line here is the 1 year. So look at the GL2, 6.96%, pretty good. The GL1 suffered a whipping, as did the investment grade CMBS, as did corporate high yields. Now, the reason for that, I think, is pretty clear. They were fixed rate indexes. And when the Treasury is raised 10 times, raised rates 10 times, that's what happens when rates go up. As you know, 80% of the GL2 is floating. So we actually did pretty well. Now, again, you can go back if you'd like and compare that across terms, 1, 3, 5, 10 inception. And since inception, which is now 13 years, the GL2 is done, call it 8.5%. The GL1 is done only 4%. So 450 basis points extra for the high yield. It's funny, I remember, Michael, when we first started, and people wanted to create a high yield index, and they wanted to say, well, what if we just add 50 or 100 basis points on the GL1? Is that high yield? And I think our answer was, we don't know, but we don't have any data to support that. But now we do, and now we have 13 years of data. All right. Let's go on to results by loan types, and here to fill in that is Alex. Alex, we can't hear you.
Sorry about that. Thanks, John. So speaking of performance, and we're going to take a closer look at the different types of subordinate loans in the portfolio or in the index. And what we see here is a bit of a divergence in performance based on the different strategies. And you can see here leveraged whole loans, first quarter 23.11%, mezzanine 193, and other subordinate debt at minus 61 basis points. I'd like to say this is a reflection of the particular strategies within here, but at this point in time, I think it's mostly due to the valuation policies of the underlying investment vehicles. And Michael will certainly delve into this a little bit more later on in the presentation about winners and losers. Next slide.
So before you go there, Alex, let me just remind participants, if you'd like to ask a question, there's a little Q&A down at the bottom. Ask away. We'll get to answer as many of those as we can. So Alex, go ahead.
Okay. And now on this slide, what we did was taking our 5-year rolling performance, we decided to compare this to the Odyssey real estate assets. Now, as a reminder, the Odyssey index is a fund index, and what we've done is taken a portion of that, but reflecting just the underlying real estate asset returns, so not including fund level leverage and other various aspects of that, different positions they may have at the fund level. And what we did was we compared total returns looking back. And what we see here is a very steady, as you'd expect, return from GL2 over the past 10 years with a 7.6 return versus 6.5% for Odyssey real estate assets. And what we did on this chart is we indexed it so we could see kind of what $100 would look like from 5 years ago to today. And we've seen, very, very low volatility out of the GL2 index, as you'd expect, very primarily driven by income returns, and a bit more volatility in the Odyssey due to the capital value changes that have been experienced here more recently. And it wasn't for 4 years that Odyssey lagged the GL2 index return. More recently popped back up over, and then now is again dipped back down below. So what we're seeing is fairly steady returns out of the GL2, and Odyssey time will tell. Next slide.
Okay. Thank you, Alex. We're going to talk now about what we used to call research and analysis, but now it's winners and losers. So we'll go over first a little bit about the maturity profile of the GL2, what the realized IRRs have been, and what's going on from credit, what's going on from history, and what can we learn. As I said, I think one of the nice things is when you have over 1,000 transactions, you really have data that allows you to both look back and look ahead, because the database is deep and it's over 13 years. Here to drive is Michael.
Thanks, John. Let's go to the next slide where we've got the maturity profile. This really is not a winners and losers story here, but this is one of the items of data that we've gotten a lot of requests for in the past, and we thought it'd be worth taking the time to run through and provide this to folks. So what we have here are actually two charts. The one on the left is a very standard maturity pattern. And these are for loans where we know the maturity dates, and the maturity dates are out in the future. And so you can see, not surprisingly, given what John mentioned and what all of you who are active in the market know, these tend to be loans typically 2-3 years in maturity, sometimes out to 5, and there are some much longer loans, but they're in the minority. And again, the maturity profile reflects this. A lot of stuff within 3 years or 36 months, as we do it on the chart, and then a tail that goes out beyond. The other thing that we have is some loans are extended. Again, John mentioned many times these are 2-1-1-1 deals or 3-1-1 deals. We don't necessarily always know that the loan's been extended, but we can make reasonable suppositions. And so there's also what we're showing over on the right-hand side are loans that appear to have been extended past the maturity dates that were given to us. And again, very plausible, a lot of stuff that's been extended about a year or is within its first year of extension. Then the remainder within 2 years. And the zero, there's actually a tiny amount, but it was insignificant out beyond that. Now, if you were to add up all the percentages here, so sort of the ones with known maturity dates in the future and those that have been extended past their initial maturity, it adds up to 100%. So now let's talk about some winners and losers. Well, I guess you could declare this a win. The realized IRRs in the GL2 have added up to be 9.7%. Now, John mentioned we've got history on about 1,000 loans, but within that set of 1,000 loans, 326 of them, we have the entire history. They're loans where they were originated and their origination data is in GL2, and then all the way through to termination. And that termination is more often than not, it's been a payoff, but those are winners. We've had some losers too, as we'll see in a minute or two. But overall, very solid results. And we've shown exhibits like this in the past. So if you've been with us before, you've seen some other material on realized IRRs, but we've tended there to focus on the subordinate debt only. This time, we added in the unleveraged senior loans, the very top line here, to show them. And also very important, we picked up, because of new participants in the index, well over 100 more complete loan histories through the year-end 2022.
Michael,
So,
that senior number at 10.9, that seems awfully impressive.
yeah, it is. And, of course, remember now that these are all loans that have paid off. So they're loans that were clearly originated 3, 4, 5, maybe even 6, 7 years ago in some cases, right? Because they're in the history. They didn't all mature in 2022. Some of these matured much earlier. So we've got a higher rate environment in some cases. And a lot of these were, I think, John, you and I call them, and I think maybe the industry calls them stretch seniors. So some of these were going up into the 80% LTV value added type of transactions. So we would expect a higher rate of return to come through there. And I think that's what's going on. Also, interestingly, if we look at the breakout for the real estate strategies, stabilized, bridge, transitional, and value added, at least in the realized IRRs, it's pretty interesting. And when Alex was talking about the 1/4 returns and even the 1-year returns, we saw some dispersion and, there's a lot going on in there. But with these realized returns, which are purely cash-based, no valuations here, this is all cash, cradle to grave, as we might say, that the hierarchy here seems to fit with what we'd expect. The stabilized real estate has lower returns than the bridge transitional, and that in turn is provided lower returns than value-added investments. So again, pretty reasonable results. Let's go on to the next slide. I mentioned winners and losers. Well, the good news is that significant downside events have been rare, but these events, they're highlighted over there in the red box. These are, in many cases, defaults where, if not all of the principal, a good amount of principal was never repaid. Now, the reason there's no negative 100% on here, because I do get asked this question, is there are loans that didn't repay the principal that was due at maturity and completely defaulted, but because they had made some payments along the way, the realized IRR was not negative 100%, but it might have been negative 60%. We've got at least one case of that here. So the good news is losers are relatively rare. Winners, more often than not, even if they may be a little bit of underperformance, still adding up to a pretty solid return. But one thing we can't understate too much is what the effect of losers are. So if we could have the next slide. As I mentioned, the incidence of default in GL2 on the realized transactions has been very low. It's only about a 2% incidence rate of default. but it has a very large, almost an outsized effect on the realized IRR. So we can shift ahead again. What we'll see is that, can I have the next slide, please? Thank you. There's been an outsized effect on results. So 2% defaults actually subtracted 80 basis points of returns from the entire 326 loan sample. Had those few cases of default not occurred and or not been as severe, we would have had 80 basis points more of realized return. Anyone out there who's an investor, portfolio manager, pension fund knows how important avoiding losers and trying to minimize losses is when you're managing these kinds of portfolios. Very dramatic proof of it here in realized IRRs. So let's continue in that theme. Probably the most asked question, or maybe the second most asked question we've had in recent months is, do you have a loss history for GL2? We've been reporting to our participants quarterly. We talk about credit events that are occurring in the index, report on delinquencies, defaults, mark to market, in some cases when there's realizations on the severity. But we've now got enough history, and it's important to have this history, that we think we can represent a good, consistent loss history. So I'm going to talk first about the credit events that we included in calculating this. This is the work that Alex and I conducted. Most of the credit events fall into the categories of either interest forgiveness or defaults. So the interest forgiveness oftentimes is when a loan might have had a period of interest deferral, say during the early days of COVID, when things were being worked out, and then later some or all of that interest, which generally had been accrued, was forgiven. So it is a credit event because you didn't get contracted for interest, but it was forgiven. Low severity of those. In contrast, the defaults, we saw the worst of them showing up there, but we have some partial defaults where some of the principal was repaid either over time or at maturity. And then we have the total defaults where nothing was repaid. Oftentimes those were bullet loans where all the principal was due at maturity. Less frequent, we could have the next image up. Still within the credit event history, we have some non-performing loan sales, currently still very, very small number. Now that may change going forward. And we've also seen a very modest number of restructurings that have involved principal reductions. So there is a valuation change there that in our minds constitutes a credit event. Again, in our conversations with participants, we are aware that there are conversations being held with borrowers, and we may be seeing more restructurings in the future. Now, what we didn't include were delinquent loans that were completely cured. So everything did get paid. Loans that had interest forbearance that didn't then have a credit event subsequently. And then cases where the interest was deferred to help the borrower through, say, the COVID situation, but the deferrals were fully repaid. And we have examples of all of these again in the data. So where does this leave us for credit loss history? Well, let's take a look at the calendar results here. So we've gone year by year, 10 years. We left out the first few years of the index because there were no defaults and the index was on the smaller side. But as you can see, there's some years with no defaults. You can see the severity, the incidence rates, and then the credit loss. Here, credit loss is the percentage of the total outstanding principal during the year on average for the GL2. Not going to go into a lot of detail here. Those of you who get the slides can look at it more closely if you have that interest. I will point out the loss severity fluctuates. Years with very low severity, those are the ones where it's probably just an interest forgiveness event or a restructure. The larger ones clearly have at least some component that are those big defaults that I mentioned. My main takeaway from this, twofold. One is that, on average, the credit loss history, the credit losses have been pretty low in GL2. Now, of course, we've had a very benign environment, at least up till 2020 when COVID hit. And some might argue, at least from an interest rate viewpoint, a very benign environment until 2022, helping both the value of real estate assets and just in general, the economy. But notice now we've had 3 years in a row of credit losses. I think we're turning a bit of a corner here as we enter this tougher economic environment. More commentary on that to come, where we're maybe moving from a case where the credit events were sort of idiosyncratic, asset-specific events to an environment where the underpinnings, be it the interest rate environment and or the broader economic environment, are going to create more stress in real estate assets. So let's look at that. Talk about values. These are all the things that are relevant to looking at stress values. We know they're starting to go down. We've seen, as Alex mentioned, some valuation adjustments being made in the debt. There's how much principal is actually exposed, and what magnitude of downturn makes the principal exposed and by how much, how long it takes to recover, because the longer it takes for the economy or asset values to recover, the greater the amount of stress, the greater the exposure. Okay, so those are sort of our, yeah, John.
Michael, let me, we've had a number of questions.
Okay, good stop. Good
take
stop.
one at this moment. Question from the audience. What drove the higher credit loss in 2014? Was it driven by a few loans? Question.
Yes, there were a couple of particular cases where loans had 100% defaults.
Okay, all right, thank you. I think let's move ahead. We've just got more questions than I think we'll have time for, but we'll get to all of them either during the presentation or afterwards. Thank you. Go ahead, Michael.
So let's look at where the commercial real estate, where the private mark-to-markets have been. This is on the asset level. We used Odyssey asset data here. It has the advantage of, because these are in open-end funds, they're marked, the assets are marked to market quarterly. So again, no leverage on these. These are measured on an unleveraged basis. So we're just tracking by how much were asset values marked to market. We can see during the GFC down 31%, the 1990s downturn, for those of us who were around and remember it, was also down about 30%, although it took a heck of a lot longer to get there. That was sort of what I call the let the air out of the balloon slowly era of valuation adjustments. GFC much more rapid. And then a little bit harder to see, we've got pointed in with the arrow, we're currently down about 8% from the peak values, again, using Odyssey assets as a guide. Let's flip ahead to the next slide, because I wanted to focus specifically on CBD office, probably the sector of greatest concern to investors. And also we have to be sure, the Odyssey sector composition has varied over time. So here we're going to focus specifically on CBD office. And you know, folks, we've had big office mark-to-markets in the past. We've had other cases and been in other economic environments where the demand for office space has fallen well below the supply, whether it's supply being created, new supply being created, or just vacancy from exiting and shrinking of tenant footprints. So we're down about 15% in CBD office so far, and we're down in a kind of not inconsistent with where we've been in past cycles, both for the magnitude of the decline at this point in the cycle. But, you know, interestingly, and maybe coincidentally, who knows for sure, in the GFC, we were actually down further by this point. But again, I know John and I certainly remember, and Alex might too, for that matter, what those years of 2007 through 2009 were like, when there was almost literally panic in the streets.
I mean, there was almost a collapse of the banking system.
Yeah, so
very different than the 90s, but unfortunately, I do remember both.
Yeah. So we've seen these very dramatic mark-to-markets before. So now let's go and talk about, okay, these are the mark-to-markets, these are the declines. Let's look, and I'm going to use the GFC, the global financial crisis, or the great financial crisis, as kind of an instructive example. Not to say that we expect another GFC, and certainly not to say that history will replicate itself exactly here. But I like to call this tracking the V's. And the V's here are going to be various indicators. In this case, the first chart we're looking at are jobs. So this is US employment. The starting point of the V is the peak, indexed to 100. So in this case, when was peak employment in the US reached? How far down did it go? In this case, that would be job losses. So on a percentage basis, we lost about 6%, little over 6% of the jobs from the peak to the bottom. It took us about 2 years for call it the real economy to hit the bottom in the job market. And then it took about 50 months to recover. And again, some of you who may recall the so-called jobless recovery that went on at this point. And it was slow to rebound, whereas more typically economic cycles had seen jobs rebound more rapidly. So there was a lot of concern, rightly concern, about the relative slow recovery of jobs in this GFC related downturn. So remember, this is down 6. Let's go to the next slide and look at perhaps the biggest liquid public market. That's the S&P 500. This is the S&P price index, not a total return index. And I will point out the left-hand scale has changed dramatically. The gray there is still that V from the jobs, but instead of down 6%, the S&P was down 56%, or actually 57%. It started falling before the real economy started to turn. It bottomed about a year before the turnaround in the real economy. And again, it was a relatively slow recovery, but because the bottom occurred earlier, its full recovery back to its prior peak level also happened well in advance of when the real economy recovered. And last but not least, let's look at those mark-to-market commercial real estate values. This is the same 31% that we saw. This is the same data, and it's in between. So it didn't fall as much as the S&P 500, but again, remember, these are unleveraged assets. Its bottom was a little bit later, so a little bit delayed, not atypical for a private market with private market valuations, but it did bottom a little in advance of the real economy. And the recovery, again, took a long time. The actual full recovery occurred after both the liquid public markets had recovered and after the economy had recovered. So again, a very much a delayed recovery across all these indicators of economic activity and financial market pricing. So what about the stress in the CRE market? Now, this is not a V. It's not even an inverted V. I suppose it might be an inverted U. So the red here is delinquency, and it's a composite of delinquencies in the banking system from the FDIC data, and also both delinquencies and restructured loans from the American Council of Life Insurance data. And you can see this rises dramatically. This delinquency measure went from sub 50 basis points up to about 225 basis points. It literally didn't triple, didn't quadruple, it quintupled during the GFC. And it took a long time to recover as well. And I think this is the nature of the stress. You can see that it starts accelerating, the stress levels and the incidence of stress starts occurring as the other indicators are going down, but it doesn't peak until after the other measures, be they private market assets, public market assets, or even the real economy, has hit bottom and is on the rebound. And again, it's a potentially lengthy time to recovery. Okay, so let's talk now about the GL2 and stresses. Well, I don't have a very good crystal ball. I don't even know if the economy is going to go down. I think it's one of the things that's under a lot of debate. Does the Fed successfully engineer a soft landing, or do we hit a hard landing? Maybe we'll talk about that a little more. But one of the things we can do with GL2 is to say, okay, we know the attachment points, we know the collateral values. If we stress the collateral and it starts burning through the equity, the borrower's equity, how much principal within GL2 becomes exposed potentially to a loss? So this is not forecasted losses. This is the potential exposure of the principal to losses. It's the orange line. And in this chart, we're only looking at the sub-debt because the senior loans are pretty well protected. And I will get to that on the next slide. That's the orange line is the sub-debt. And I've shown it against two alternatives. The grayish line is 100% unleveraged equity. The orangish or yellow amber line is equity leveraged at 25%, which is roughly the amount of leverage used in the aggregate on the assets that fall into the Odyssey funds. The red line is a changeover point. So yeah, sub-debt, some of you may be investing in sub-debt in part as a way of having some downside protection and not being exposed to the first dollar of loss of equity value. And that works up to a point. And then it crosses over. Now, the good news is, at least for what we see currently in GL2 and the nature of the collateral, you have to get up to a level of decline that's certainly beyond where the GFC was, and probably even a little bit greater than what we saw in the 90s. It's kind of in the upper 30% decline in collateral. And again, that doesn't mean GL2 is going to lose 30% of its value. It means 30% is exposed to these stresses and is, in other words, is not protected by equity in there still to suffer the first dollar loss. Let's take a quick look just at distinguishing across the various components of GL2. Not surprisingly, it's all related to risk. Sort of where are you in the capital stack is going to determine the exposure. So here we can see, I did put the senior loans in here. The current senior loan composition of GL2, they're pretty well protected. We just wouldn't expect, even at a 30% decline in collateral value, a lot of exposure there. Then as we move up along and our risk measure increases, and the risk measure here is totally related to the positioning of the cap stack, both the attach and detach points and how big the slice of the cap stack is. We go up, and this is not to say mezzanine debt is inherently riskier than B notes or leveraged whole loans. It's just currently in the GL2, the cap stack positioning of mezz loans is such that their risk exposure is greater. So hence they have the higher loss exposure. This stuff could change. So what about the outlook? Well, I already mentioned it's not clear if the real economy is going to hold up. Is the Fed going to succeed in engineering a soft landing? Are we going to have a hard landing? Clearly also, we've got a different Fed environment. If we look back to the GFC or if we look back to COVID, in the GFC, the Fed responded to the financial stress and lowered interest rates. And that certainly eventually helped asset prices rebound, as we saw. And even then, even with a very accommodative Fed, it took a while for asset prices to rebound. We saw the Fed be very accommodative in COVID, even though the economy did have a much quicker recovery there. But this time around, instead of lowering rates and being accommodative, the Fed's fighting inflation, and the interest rate hikes are starting to bite into asset prices very clearly. The levels of stress across sectors are going to vary, no surprise. Biggest concerns these days are for office, and in particular CBD office. Although, John, I think you and I have talked, and you've pointed out, not all offices are created equal here, are they?
I don't think so, because Michael, I'm reminded of when Tip O'Neill was Speaker of the House during the Reagan administration, and he was a big Massachusetts politician. And one of his comments was that all politics is local. And I think he was right, but all real estate is local too. So if you've got a Midtown New York building, mid-block office building, you're definitely not having a good time now. And I could list a number of other cities that aren't doing too well either, but not all. For example, if you've got an office building in West Palm Beach or in Miami, you're doing quite nicely. Nashville, certainly better. Austin, to be seen. But it's not fair to say all office buildings everywhere are suffering. Obviously, it's uneven, and like politics, all real estate is local. So
I think if we were painting, again, using probably too broad a brush, we'd say most likely multifamily and industrial will do well, and retail peaked quite a while ago, and at least in some cases, there's certainly going to be ongoing struggles with malls and repositioning, but some retail is actually doing very well, thank you. So,
yeah, Michael, it's interesting because when we talk about the stress in office buildings, I'm reminded that it wasn't that long ago when you couldn't give away a retail deal, and that's not true anymore. Now, is there a big bid for multi-story internal malls? No, but there's a good bid for a grocery anchored, for strip retail, for, as I would say, Starbucks anchored, and we're doing those now. So it's not fair to say, are office buildings down? Yeah, sure they are. But again, I can look at a time not that long ago when you couldn't do any retail because we all knew that the internet was going to take over retail and there'd be no need for bricks and mortar. That's obviously not the case today.
John, I remember in the early 1990s, telecommuting and hoteling were going to knock out all demand away for office.
Yeah.
And I guess it took us 30 years to finally get there in the advent of Zoom, which didn't exist in 1990.
Yeah, couldn't even spell it.
Yeah. Okay, let's go. An important point here. We've been talking about mark to market, and mark to market's not the same as impairment, right? Mark to market is part and parcel of what we as investors, portfolio managers, we see it. It has to be done, particularly if you're a fiduciary for your clients and if you're plan sponsor to beneficiaries, et cetera. So we have to do the mark to market, but that doesn't necessarily mean that it will be impaired or permanently impaired. I think there, as I tried to allude a little bit in the prior slides, a lot of it takes, how long is the mark to market, and does the real economy stay low and not allow earnings to rebound? Do interest rates stay high and not allow asset values to rebound? Because both of those are going to affect both the ability to service debt and then the ability to refi or pay off debt. And I got one more point, and then we'll go on. And I think this is my opinion, and John and Alex may not agree, but my opinion is if this cycle even remotely starts to echo prior cycles, it's not that we don't have distress today, but we're going to talk a lot about distress in 2023. And we already have talked a lot about distress in 2023. I'm going to be on a call tomorrow with some folks I work with talking about distress in 2023. But I think where we really see it, it's that lag effect of that red line on the prior chart. 2024. I think we'll talk about it in 2023. We're going to keep talking about it in 2024. We're going to do deals. We're going to see distressed deals in 2023. And we're going to see more in 2024. John, I don't know. What do you think?
Feels right to me, Michael. I just I keep looking at the Fed and thinking that I can predict. And of course, I've been so wrong for so long, I've stopped predicting. But it does seem like to me that their intention continues to be higher for longer. And I'm not sure where that silver bullet's going to come, where we're all of a sudden going to be back to, quote, what we think was or is normal. So I think we'll have quite a bit to talk about this year and a lot more results to see next year. All right, so
yeah, John, I'd just like to make one final comment just to people in case
Please.
people think the market is totally seized up. We haven't pulled all the data yet, but I'd like to point out in the first quarter, new GL2 loans were being made. And in the first quarter, new GL1 loans were being made.
for sure.
So we know that transaction volume's down, but it's not non-existent. And I think that's a positive sign.
Yeah, I agree with you. We've looked in the GL1 and seen that it's certainly less than it was a couple of years ago, but it's not non-existent. And yet I'm sure we could go back to 2009 or 2008 and see virtually nothing while Lehman Brothers and Bear Stearns and AIG and others were collapsing. So Michael, we've covered a lot this morning. Thank you, Alex. Thank you, and Julia Grant as well. As I mentioned, and I was afraid of this, we have more questions than we have time. So we will respond to those that ask questions, or if you didn't ask them, send us a note. We'll be happy to either call or to send you a note. I might tell you that the conference has been recorded. So if you'll go on to the JB Levy Co. Website, you'll be able to get them. And in addition, and you guys did this last year and it was really, really helpful. We used to call it Survey Monkey. Now it's called Zoom Survey. So please fill out the Zoom survey. Tell us what you did and you didn't like. If you need slides, again, I might remind you that they're all copyright protected. But if you email Julia Grant at her email address, you'll get really quick service. We'd love to increase participation and data contribution, whether that be the GL1, the GL2, or our new GL3. So if you're interested in participating and you aren't at present, let us know. If you are looking for the first quarter results and you're a participant, you'll get them from us today. I think that, Michael, that covers it all. It's been really interesting. On our last slide, you'll notice that if you want more information, email Julia Grant and she'll be quick to respond. Thank you all for joining. We look forward to talking with you in the year to come. Thank you, Michael.
Thank you.